So how much is this call to do with the valuation aspect of things?
Thanks, Shery. Really happy to be here. That's a good point. Valuations, I think, give us a margin of safety and a buffer. Right now, emerging markets are trading more than one standard deviation below their historical average. And at the same time, I think most allocators and investors have been possibly over-allocated to the U.S. over the past decade or so and done well because of it. But now those valuations appear stretched, so it seems like the margin of error, mean reversion, would be towards emerging markets.
You can actually see the discount on that chart that you kindly sent us. But I also have to talk about the direction of the US dollar, which is what a lot of people are pointing to, and that inverse relationship with emerging markets. I do wonder, though, how much longer could the weakness in the dollar stay for, and what are your projections on how that will guide EMs?
Sure. So I've always thought that there are two main drivers for emerging markets outperformance. One would be incremental marginal growth, and we're seeing that this year as developed markets are slowing down from about 3% to 1%, while emerging markets are still clipping around 4% annual growth, and that's driving flows to these countries. So whether it be in fixed income, equities, or currencies, and then you can translate that into currency being the second biggest driver for emerging market performance. So as flows come, they're going to support those currencies, and then emerging market countries and the companies within them are generally levered in floating rate debt. US dollar denominated debt. So as interest rates come down and as the dollar weakens, then you should see balance sheets shrink and net interest expenses come down and see positive earnings revisions because of that. And historically speaking, as the Fed reaches the peak of its hiking cycle and we reach a pause, that should translate into a weaker dollar looking forward. So we're optimistic about it.
So historically, you would see a stronger correlation in terms of the EMs that are exposed to China. Is that relationship starting to weaken now?
No, I'd say if you're looking at the asset class broadly, China is still a key driver for emerging markets. It still represents 30 to 35% of the asset class by market cap. However, if you're with an active manager who can underweight China and position yourself separately, I would say that these economies have begun to decouple. There's been a lot more focus on domestic consumer growth. A lot of these countries are starting to benefit from sort of supply chains moving away from China, countries like Mexico or India or within Southeast Asia. All of these are actually benefiting from a bit of China's demise. So yes, I definitely see that correlation coming down.